All right, welcome back to episode 2. Today, we're going to discuss how to continue building wealth in the military and what to fix first. So, today, the purpose of this episode is help all the listeners identify which financial scenario closely resembles your current situation and understand the general order of operations in regards to what you should do next. You do not need random financial advice. That's the last thing you should be doing. You need to know what to fix first based on where you're starting in your current position. So if you've been trying to build wealth in the military, but you got debt, a car payment, a mortgage, limited savings, and no idea what to fix first, then this episode is for you. A lot of people go on YouTube and just search for random financial advice, and you'll get it. They'll tell you to pay off all your debt first, invest everything you can, buy a house, sell a house, open a Roth IRA, increase your TSP contributions, get life insurance, set up a trust. But what should you actually do first? And the answer depends on where you're starting. So today I'm going to walk you through some three common scenarios so you can identify which one sounds mostly like you and understand the next steps you should consider. And I'll also tell you which one that I fell into. Disclaimer: this episode is for general financial education, and your personal should be based on your income, debt, interest rates, benefits, your family situation, your goals, and your professional guidance. We need it. I do provide one-on-one coaching, so I can help you with that if you're interested. All right, moving on. So the principle is your money has to have a mission. We talked about that. The goal is to not blindly follow a one-size-fits-all rule. The goals are the three that those are our core foundations: build wealth, protect assets, and create freedom. So before we go into these three scenarios, I want every military family out there to start asking these questions. Where is my money going every month? Do I have an emergency savings for unexpected expenses? Am I using my TSP intentionally? If you don't even know what TSP is, it's Thrift Savings Plan. It's the government's version of a Roth IRA. And we'll have a different episode about that. It's highly lucrative. Next question. If I am eligible for TSP matching, am I capturing the full match? If you don't know what that is, we'll discuss it. Which debts are charging me the highest interest rates? I'll tell you how to find that out. If something happened to me, would my family know what to do? That's a very big one for me. Are my beneficiaries' will and asset protection documents organized? We'll discuss that too. All right, here we are. Scenario number 1. You own a house, you have a car payment, and you carry credit card debt, and you have very little invested. So this person, of course, looks successful from the outside. They own a home, they have a vehicle, they make decent money, and they may have some equity in some of their house. But the majority of their money is flowing into payments instead of building wealth. So if you're in fit scenario 1, your first step should be number 1, keep building the wealth habit. If you're eligible for a TSP match, understand what you need to contribute so you're not leaving available matching dollars on the table. The minimal contribution that you must put into TSP is 5% if you want the government to match you with the 5%. This only applies for people that came in under the blended retirement system. If you're on the legacy retirement system where you retired with 20 years and you got 50%, then this does not count for you. We're under the old system, so you got to continue matching, and whatever you put in there is just going to grow with compound interest as the stock market fluctuates. We can talk about where to put that money in a different episode. Step 2, build a starter emergency fund. Need some cash available for unexpected home repairs, car repairs, family emergencies, so every surprise does not go back onto a credit card. And in later episode, we can discuss some of the different options to build a emergency fund. types of as far as the types of accounts. Step number three: protect the assets you already own. You have a house, so you need to review your beneficiaries and speak with an appropriate legal professional about a will, power of attorney, and whether or not a trust or estate planning tool is appropriate for your situation. I have a link I'll drop in the description. You can actually check out the link. It's through Legal Shield. They provide actual subscription based legal protection, and you get access to lawyers to work on your specific goals. I personally used it to build my trust, and so that's something that I highly recommend. Step number four: attack your high interest rate credit card debt. Your credit card payments are stealing your monthly margin. That means they're stealing a lot of your money that you could be using to build wealth. So create a plan to target the ones that are highest. The way you'll find that is go on each of your credit card statements, click on account details or loan details, and it'll tell you the percentage rate. And then whichever one has the highest, start attacking that one first. And what you want to do is, if you got money to do it, instead of paying the minimum payment, you want to pay a little bit more. And a little trick, you can actually click on a drop down and say you want to pay towards the principal, which means you can pay towards the principal, which means that's the amount that you're paying without interest. So you can also do that in a lump sum to lower your total credit card balance. All right, step number five: redirect your freed up money. So as your debt payments continue to disappear as you pay things off, take that money that you used to put towards credit cards and put that into savings, investments, or different accounts, as far as towards debt reduction. So you'll do what Dave Ramsey did, which is the snowball effect. Which, if you're paying $300 on a credit card and it's done, instead of taking $300 and discarding it, now put that $300 on top of the minimal payment for the next credit card that you have. And we're just going to keep doing it. The goal here for a person in scenario number one is to stop sending majority of your money to creditors and start sending more of your money towards your assets. All right, scenario number two: you do not own much yet, but you have a car payment and a lot of debt. You may feel discouraged if you're in this situation because you don't own a house. A lot of people are like, "Oh, get a house," keeping up with the Jones. I didn't buy a house until I was already in the Coast Guard for 20 years. I personally didn't want to have to deal with the headache of managing something while I'm in a different state. And so I chose not to get a house until now, where I know we're going to be settling for an undetermined amount of time until my kids are out of high school. You may feel like you're behind, but actually you're in the perfect spot. You have a huge advantage. You can actually start building the system correctly from the beginning. So this here typically applies to a lot of, E3s, E4s, people coming in the military for the first time. So your first steps: start tracking every dollar. Look at your credit card statements, look at your debit card statements, and see where your money's going. And so that way you can figure out if you're eating out too much, putting too much towards subscriptions, too much towards shoes, clothes, etc. Your next step: build a starter emergency fund. So ideally, you want to have $1,000 in emergency savings fund, and you can do that, of course, by putting monthly deposit in there, or if you got the $1,000 up front, just put it in there. And this is going to create a buffer, so that way, let's say if a unexpected expense comes up, you don't have to grab that credit card and get yourself more into debt. And once you get to $1,000, don't stop there. Keep building. Keep putting at least like $150, $200 every month. Just let it build. Next, you're going to start your wealth building. If you have not started contributing to your TSP, well, you need to start doing that. You need to start off with 5% to make sure that the government is matching. If you are part of the old system, but you're still staying in, so like you're at 20 years, but you're going to do 30 as like E8, E9, etc. 26 as E8 in my service Coast Guard, and 30 as a E9. Well, you can start increasing that to 10% if you can afford it. The goal is to begin building assets while you're cleaning up your debt. Step number 4, attack that high interest debt. Prioritize the debt that's draining the most money from you through interest. Step number 5, evaluate that vehicle payment. So you need to ask yourself, does this vehicle support my financial goals? So if you're a brand new E3, E4, and you went ahead and got that Mustang for 50K and you're spending $1,000 a month on the payment, yeah, I'm just straight say it. You probably need to get rid of that. You need to get rid of it while it's still worth some money so you don't lose out too much, or find a way to refinance it if you can with a better rate, and don't make that mistake again. Step number 6, as your debt decreases, take that money that you got left over into savings, thrift savings, and other appropriate long-term assets. So you're going to take that money once you pay off some debt or some credit cards or debt. You're going to put that money into building that emergency savings more. You can even contribute more of your thrift savings plan, or you can put it towards long-term assets like opening a brokerage account or a separate Roth IRA, things like that. Or here's a little secret: life insurance. The younger you are, the better. I know you may not be thinking about this while you're young and dumb, because we all been there, but one day you're going to blink and you're going to be 40, like I am, and you're going to have a wife and kids, and a house, etc. That's not the time you want to be looking for life insurance, especially if you're one of the people who does not keep up with your health. You want to get that because it's for life. And so you can get a term life insurance policy that will be good for life. And you can get it really early. I gave you a plain example. I got my life insurance when I was 28, and I only paid $30 a month for 500K. Great example. So if you're in a situation, scenario number 2, you're not too late, you're not stuck, you just need to start. And number 3, this is the one I related to the most. All right, so your own assets, you got some investments, but you have a lot of debt. So this person typically owns a home, has stocks, they contribute to TSP, they got other investments, but you still feel financially stressed because your debt is draining the majority of your cash flow. That means the majority of your monthly pay is going to paying off credit cards, uh, paying off your house, paying off, uh, medical bills, car bills, etc. Credit cards you should have never gotten. That one vacation you took and put on the credit card so you can get points, but you didn't pay it off in full. So now you're on that payment plan. Yep, been there. Your first step: take inventory. Look, get a list of all your debts, all your interest rates, all your assets, investments, savings, insurance, beneficiaries, and monthly obligations, so you can see exactly what you have and what you don't have. Step number 2 is protect the assets you already built. So you got to review your beneficiaries and your estate planning documents. That means dealing with a will and a trust, and make sure your family understands where these important documents are if something, God forbid, should happen to you. We can go more into detail of what happens when you own something and you do not have these documents set up. The short version is the government can take your house from you and you may not get it back. Step 3, identify expensive debt. High interest rates on your debit credit cards. Got to get rid of those. It's taking your money. You got to get rid of it. Any means necessary. If that means if you were in a situation like me where we were spending like $2,000 eating out, I just said, you know what, man, I'm just gonna take some automatic deposits from my paycheck, put $500 a month because I know I can afford it because it was going 2,000 to eating out. That's going towards that extra credit card. Knocked it out and went about my business. You know what I mean? Step 4, don't make any emotional investment decisions. This is for people in this situation simply because you got kids, you got a house, etc. You may be stressed out, you may be fretting because you didn't do what you're supposed to do, and now you have to make up for the years of loss. You're more likely to make an emotional mistake. So slow down. Don't sell your investments just because your debt exists. That would be the biggest mistake because you cannot get back your compound interest. Understand that interest rates, your tax considerations, family needs, and long term consequences before you make a decision. Um, I'll give you a clear example. I really didn't want to buy a house, but with the BH in my area, there was no way in hell I was going to get a house for big enough for 5 people. So then I had no choice pretty much, unless we're going to live in a 2 bedroom apartment. That's all my BH could afford. So then we started looking at houses, and then we looked at houses in a better area that's going to have more bang for your buck, bigger space, and cheaper rates. Um, and of course, I tried not to get my emotions in it. But in the process, end up buying some other things emotionally to try to undo the money that we had spent. Because of course, with a house, it may start off at 2,600 month, $2,600 a month, but then as interest goes up, if you have a if you don't have a fixed interest, which I do, the county taxes went up, or your escrow, the insurance for your house, it's not billed correctly, then you end up owing more money. So I can tell you personally, my house bill went up from 2,600 now to 3,200. Give you a good example. Step number 5, create a deliberate payoff strategy. So use your monthly cash flow to attack that expensive debt, high interest rates, and continue to build and protect assets. Don't stop the TSP contributions. Keep on and put it into quality companies. Do not follow all the trends on YouTube. All right, step number 6, redirect your freed up payments. Once you eliminate a debt, take the money that you have that you're paying there and put it towards another debt, or put it towards savings, creating family memories, freedom, etc. Because we do want to have a good life. You know, we're not trying to make things so miserable that you end up quitting. Because if you don't do something that you can bear with for extended period of times, you're more likely to quit. And so those are the 3 scenarios that cover the majority of people in the military, for military dads. So yeah, key takeaway: your first move depends on your starting point, but the overall system stays the same. You're going to build wealth, protect your assets, create freedom. You're not trying to become perfect overnight. You're trying to stop guessing with the money and start making intentional decisions in the right order. So if you want to help identifying what you should fix first, go to my website. I'll put the link in the description. Sign up for our webinar. And if you sign up for the webinar, you actually get a checklist that's going to cover everything we discuss. It's going to give you an outline of where your money's going. And then there's another sheet that you'll get on there that you can put in how much money you've been contributing, how much debt you have, etc. More of the numbers. And then it'll ask you if you have, a trust, a will, etc. And it'll basically point out what you need to do, your steps. Also, book your legacy launch consult with me. It's a pre-call before the webinar. It's 20 minutes. Basically going to look at your specific situation and tell you what you need to prioritize based off where you're at in these 3 scenarios. And we'll look at your starting point. We'll identify any gaps you have. So if you don't have life insurance, we'll check that out. If you don't have a trust or will, I'll give you some recommendations on those things. And I'm going to build you a step-by-step plan for your money within those 20 minutes. That's the free thing I'm going to do for you if you simply sign up for the webinar. All right. And next thing, if you own a house or assets, make sure you talk to qualified legal professional about your will, your beneficiaries, power of attorney, etc. So for those that are active duty in the military, for my father's there, you have legal assistance. You have that's something free you can do in the service. Go to your legal assistance office, tell them you want a will. They'll give you a questionnaire, you fill it out, and then they'll build the will based off what you put in the questionnaire. Same thing for the trust. Except for legal assistance will not do a trust for you. That's something you'll have to probably do externally. I'll double check, but at least that's not offered where I'm at. So if you want to get a trust done for really cheap, I have a link in the description where you can get access to attorneys and get your trust done for no more than $35 a month. And then you get your will done or get your trust done, whatever you want to get done. And once you're done, you can cancel your subscription. Simple as that. All right. So until next time, remember, build wealth, protect assets, and create freedom. God bless.